Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining me is Phil Mackintosh, chief economist at Nasdaq, to discuss distortions caused by super easy monetary policies. And Phil, we see stocks higher this morning, but the rise in bond rates created some headwinds last week.
It sure did. I mean, we've had a tough couple of weeks for stocks, really. We had a little bit of a bump after Chair Powell said, look, rates are going to stay lower for longer. But in general, the trend for the last 2 weeks has been for equities to be facing headwinds, especially the growth stocks. And if you look at the bond markets, you kind of see why. The rates on the 10-year, the rates on the 5-year have all been increasing pretty steadily. And so, like we've talked about before, if interest rates go up, the sort of rate of return you need on a stock to outperform goes up as well. And so it tends to harm valuations. And the real reason is, why is the rate going up? And the answer is people are starting to worry a little bit about inflation.
And Phil, this isn't specific to the United States. This is a rise in global rates as well.
Yeah, that's a really good point. And I mean, if you think about it, every single country in the world has COVID. Every single country in the world has done kind of what we've done with massive fiscal policy. And so governments have a whole lot more debt, but there's also a whole lot more money in the system, increased money supply, increased savings. One of the really interesting outcomes of that is if you look at Germany, a lot of European bonds have actually had negative interest rates for a number of years. Germany has actually stopped paying interest on deposits in some banks. So, it's going to cost you money to leave your money in the bank in Germany. And that's really highlighting, I guess, just how easy money has been for years.
And Phil, another issue is the supply bottleneck that we're seeing with freight prices climbing. What's the potential impact there?
Yeah, I mean, that's just one of the aspects where you're seeing input prices increasing for corporates. I mean, there's so much money in the system. We know that retail spending is above pre-COVID levels, especially for manufacturing and goods sectors. And so that's translating to a lot of demand for goods. And if you look at the shipment costs, it's started to go up. So there's obviously some supply constraints, not just in the shipping industry, but there's a lot of demand for products in the world. And you can see some of the stimulus distorting how the economies are working now as well.
Right. And that's my next question. Is there anything that you can discern from the personal spending and income data as it relates to stimulus?
Yeah, so we can see pretty clearly in the personal income data the impact of the stimulus checks that went out last month. And as you'd expect, that's sort of translated to an increase in spending as well. What you tend to see, though, is people save initially, and so the spending lasts for a little bit longer. So you'll expect to see a sort of a prolonged boost in spending caused by the January stimulus. And we know that last Friday, the House just passed the new stimulus bill, which is for another 1.9 trillion in theory. That's going to the Senate, but just so much money in the system. There's actually been an increase in people's income during coronavirus and an increase in savings because of the stimulus checks and the scale of the fiscal stimulus, also because of the lack of spending on the services sector. Those of us with jobs have actually been saving as well because there's less for us to spend money on.
And that's a good point. And Phil, the issue is the U.S. has the largest spending boosts as a proportion of GDP. Isn't that only going to impact inflation and rates even more? It looks like it's going to be a delicate balance act and challenge for the Fed and Treasury to kind of keep this all in check.
Yeah, which gets us back to what we started talking about. So in reality, a lot of countries have the same problem. Their fiscal stimulus, the amount of money in the system compared to prior recessions is pretty much off the charts. But the US is one of the leaders in terms of the amount of fiscal stimulus that's been injected as a percentage of total GDP. But that doesn't mean other countries aren't going to have a similar problem. And that's kind of why, to your point earlier, the sell-off in bonds, which made the rates increase, has actually been a pretty global phenomenon. So economists and investors around the world are starting to watch all of these pressures play out, and they know that there's an awful lot of money in the system. As the vaccines roll out, the really interesting question is going to be what happens to spending and what happens to consumers' behaviors.
All right, Phil, appreciate the update. Thanks for joining us on Trade Talks, and thanks for joining me. I'm Jill Malandrino, global markets reporter at Nasdaq.